So we will go on with the second session. And in this session, I will speak a little bit about the structuring itself. Under this part, I would say that, like when we started, we say that it will be the ideal situation when we do structuring to consider, oh, okay, I'll just wait. Yeah. To consider a holistic way of assisting the client. This, of course, we are talking about the ideal situation. And it takes stages to get there. Not every client immediately embark on a holistic plan, but we hope eventually that they may consider that. So the holistic approach, we will say it will consist of asset protection structure naturally on the assets that they would like to house within a certain vehicle to benefit the generations. We will talk about family governance structure. And then we will also talk about oversight structure. So basically, this oversight structure that we speak of, perhaps I could cover a little bit on it here. You know, when you have the asset protection structure on one side dealing with the assets, and of course the beneficiaries are part of the diagram where they will they will receive distributions from the money vehicle, so-called. Then on the other hand, you have a family governance structure. But remember, when we set up like a situation of a trust, or we set up a situation of a foundation, those people that you place in there, many a times could be just professional advisors who are not connected closely with the development that's happening in the family as it goes. New grandchildren are born, new beneficiary may have got married, they may have moved from different jurisdiction. So the trustees would be very happy if there is a mechanism that they are informed in a certain way so that they can implement their role in a more meaningful and genuine way in looking after the families, the beneficiaries' interests. So we would put what you call an oversight structure that kind of is like an interlinking machinery between the asset protection structure on one side and the family governance structure on one side to tie the two together so that they one move in tandem with the other in a limited fashion, because the trustee needs to act independently, but the trustee would like to be informed of the needs, because after all, they are there to respond to the benefit of the children. So in a limited way, they are informed. So, so like I say, the implementation of the holistic global estate plan can, oh, there's some typo mistake there. Actually, it can come in stages. That's what I mean. And starting usually with the asset protection structure first. All the families I act for, except for one, always start with the family asset protection structure first, and then some just stop there. They didn't opt for the family governance structure. Some will proceed into family governance structure. I just have one family that I act for, start with the family governance structure, because it was too complicated. Now, most of the assets have been distributed already. Very difficult to convince everybody, every sibling, every cousin to put back the money to form the structure. But nonetheless, the family are close. The family are still very intimately related to each other. So they want a structure that continue this vibrant relationship they have. So they actually set aside a source of fund to fund this family governance structure. So I had my challenge in getting there, getting to do that. But most families will start with asset protection structure and hopefully end up. So I have some who does the whole work, but some just stop at the family governance. But they know about the need for family governance structure, and hopefully they will come along. I always say this: when our duty is to bring the information to the clients. They may say no. At least we know it is an informed no. They say no after being informed, and that's very important because they know now they know the options and they've decided no. And I've always said that no is really a maybe, because when their needs evolve, they may come around to know it. So the first step is just bringing the information to them. this diagram is of course, is a very simplistic diagram, generic. Huh? We talk about an estate with no plan. So we look at the founder. Now, the founder owns the asset directly. You have the founder family next to him. This is, of course, a generic way, very simplistic way of representing the situation. Now, the black line, is it black? Yeah. The black line denotes ownership. So long as you have the black line there, that is where vulnerability lies in terms of asset protection. Because if the client now owns it, the client passes on the estate. Is there a light here? You go. So you see the black line, with the founder owns it. Let's say the founder does a will or during the lifetime gave intervivals gifts, and the black line now is connected to the founder family. It's just a matter of shifting ownership onto the family. The vulnerability continues, the asset protection situation continues not to exist, taxation issues continue to be tied to the family members who own it. So this, we kind of call it an estate with no plan in that sense. So we are hoping to put in an asset protection structure. So now you see, there is no ownership tying the founder and the founder family. You have an asset protection entity, holding company. I use these words in a very neutral way. The asset protection can be a trust, it can be a foundation, it can be a private trust company. There are various, it can be a combination. We deal with clients whereby we may have a trust where the beneficiaries are our foundations. So, you know, they have a main trust, and then instead of the beneficiary being son number 1, 2, 3, and daughter 1, 2, 3, each son and daughter form their own foundation, so that when the money distributed to that foundation, in that foundation, they decide, that means this is succession planning for the children. The children moving on to say, because children may have different ideas. Some children will say, it doesn't matter, you know, my own children can get as much as they want, and other ones say, no, I give them enough education, a house when they graduate, that's it. Everything else has to be a very circumspect way of using it. So therefore, they may have different ideas, they may form their own foundation, and may do their own mini charter. Some would look at the main charter and then spring off a mini charter. So this asset protection entity and holding company is just a generic terms of saying, to denote that ownership now belongs to the structure. Now, we talk about holistic global estate planning. That's what we hope to do. So maybe I can put this in. Okay. So you could see, we are hoping to do the, when you have to look at reading glass, it's so difficult. Where is this one, okay. So you see now we have the asset protection structure in. Ownership now is tied in with this side. The black line with this arrow, the thick line merely show connectivity as in, not the legal connectivity, but the relationship connectivity. So we have a family governance structure. What does that mean? Usually the family governance structure, the backbone of the family governance structure is the family charter. In the family charter, we talk about who the founders are. We give recognition and a respect to the ones who have actually founded the family wealth. We talk about what the family values are and what the family traditions that are important. So those are almost like maybe a preamble, but actually is a very good substance of how the family is. Then from there on, we talk about processes. We talk about how do you elect to have a family council. Now remember, the families are all here. The founder family here. But how do you elect to have family council? Now what does a family council do? In a way, it's like your board of directors, right? You think of the charter as an M&A. I always tell clients, I say, you know, when you start off a company, a Sdn Bhd, 2 shareholders, you also may have a M&A, Memorandum and Article Association, that can run into 16, 17 pages. Why? Because you hope your Sdn Bhd to grow, and you want certain processes to be transparent, certain understanding to be captured between you and the other co-shareholder, so that whoever that comes and join also walks into a framework that is already quite well defined. So similarly, you start off, maybe now you are with 3 children who are at the age of marrying and working, but you have assets that's going to last, and you intend to bless many generations to come. So therefore, you expect to have a pyramid in your midst. Your base will grow, and therefore you should have this in your family constitution so that children start to know what were the original founders' expectations. So therefore, we have a question of how do you appoint, because families, like some of the families I have are very large. Like we have the situation of 63 family members. Doing a family constitution is something that is very meaningful to them, but it also brings certain issues. So you've got to be very patient in working with them. Usually I would have a format that kind of identify key issues to start them talking on the table. Because some people will say, oh, we don't need to do that. Some people don't want to address the issue, because a lot of times we talk about elephant in the room, right? Everybody is talking about everything else, but there's an elephant in the room, nobody is talking about it, but everybody sees it. So, and I always tell clients, if you don't deal with the elephant in the room in your lifetime, this elephant will storm the structures that you form. Because your structure can only be as strong as the foundation it builds. And the foundation cannot be loosened. So if you are alive, this is the best time to really talk about these issues, because a lot of times there are misconceptions and feelings of being prejudiced, of being sidelined. You are there to explain. You are there to hold their hands. You are there to rein them back. But of course, this places a very heavy burden on the founder. For me, I found doing asset protection is so much easier. It's already challenging, because deciding who to put in the advisory committee and all that is already challenging. But dealing with the family charter can also be a difficult issue. But you know, I find the children and the grandchildren love it. There are a lot of input that they are sought by them. Some clients will say, oh, you just give me your format, you know, a standard provisions, and I'll get them to look at it and sign it. I always tell them, you know, a family charter, if you don't get their engagement and they don't take ownership of this piece of document, then when you go, it's just going to be put on the shelf like any other M&A that you have, any other report that you have. But if they are engaged in formulating the charter, they are emotionally invested in it, they take ownership of it. It's a very different thing. So we have a situation like, for example, definition of a family. Who do you define as a family to make up the founder family? Of course, most Malaysian founders and Asian founders, they will say, must have blood, must have the family blood. In-laws are not in there. Very different. We have a North American family, most families have their in-laws within the family definition. But in Malaysia, must be bloodline. So okay, that's all right. Bloodline, we can define any of the issues with bloodline. But the question then is, what about illegitimate children? They have your blood lying in it, but they are illegitimate, right? So of course you have clients say, no way, if they want to sow wild oats outside, let them stay outside, right? But then you have a lot of different situations, like for example, children who settle in Canada, in Australia, they can opt for common law relationship. We all know that. Common law relationship is what is like marriage-like relationship. Now the law in their jurisdiction recognizes it. So, but in the founder's eyes, they may be illegitimate because you're not married, so you're not part of it. But you know, so the children will argue. I have a lot of fun with families dealing with this. The family will say, "Come on, Dad, you send us overseas. You know, in Australia, staying 2 years. Now, in fact, I think it's 1 year with the child. It's like 1 year. You are recognized. You get a certain status. The law gives respect to the relationship that you have, and the children born are recognized within the legal framework. So why wouldn't you include? Then we just decided that marriage is not for us, you know. So you have a situation. So there is a lot of argument there, but good argument, good solid argument brings a family together. Then you have a situation. They say no. Some clients will say you got to produce a marriage certificate. You want to play ball, you produce a marriage certificate within it. Then I will ask the client, what about same-sex marriage, right? Same-sex marriage is legal in some jurisdiction. One of my clients, when I approached this subject, he said, oh, same-sex marriage won't have children. If they have children, they won't have our blood in it. Of course it's not true, right? You have donors sperm. You have the lesbian relationship will have the correct procedure where one of them will have their so-called bloodline in it. So the question then is, same-sex relationship, is it within the definition of family? So this is very important, because the family is what makes up here, but it is also an occasion of much argument and much laughter. They can be heated, but they know they are the young ones know that they are asked to engage because the parents want them there. That's always the starting point. When they get a bit heated, I always remind them, the parents could have just put something in there according to their will. But they want you in because they want to hear you out. But ultimately, it is your father's or it is your mother's charter. So, you know, but being invited is already a very precious step to take it. So I have not a bad experience in this, not a single bad experience. Always turn out to be well. And in fact, like one of my clients already had the charter signed. They had the family retreat, I think, in Bali, I can't remember. And they wrote to me and said, oh, you know, the third generation came out with a very small amendment, cosmetic amendment. Should we do it? You know, actually makes no, we tell them it doesn't make sense, but they want the word in. I say, if it doesn't affect the main essence, do it. Because you want them to take ownership, right? You want them to say that, I have my fingerprint on that piece of document. You know, all of us have requested for this and it's reflected. That's what you want it to be, a living document in that sense. So the family charter would have this definition of family, a definition of marriage, definition of who are eligible to be elected to be the family council. So the default response from clients when you ask to say who would sit in the family council. Now, family council will be usually, they are mandated to decide, like for example, they are mandated to decide on how much distribution would they request the trustee to consider. Because sometimes in the letter of wishes, the client may say, annual income that comes in from all the assets under the trust, I want only 30% to be distributed to, I want only up to 30% or up to 40% to be distributed to the beneficiaries. I want another maybe up to 20% to go into the education fund. Some of my clients would want to set up an entrepreneurial fund, which is also very interesting because the entrepreneurial fund basically is a beneficiary instead of the beneficiary may have a very good novel idea for a business, might not get it from the bank because the bank may not see that this is viable. Then, but you can go to the council to consider the entrepreneurial fund to release, and it could be a loan, and the loan could be offset against a certain amount that's distributed. So that's all different kind of fund. Charitable fund is something, philanthropic fund that clients want to put. So usually it's up to. Usually the client will say, I want 40%. Now, you must remember when we say in the letter of wishes, I want so much. Like I was speaking with someone in the, they say, oh, you know, the clients want this, want this. We must remember the objectives. If the objectives of the client is asset protection as the main, we will always say go for a discretionary trust. Because a discretionary trust is where the trustee has the discretion, but always guided with trust principles. We always say trust principles are fixed, trust law is dynamic. But nonetheless, the trustee are guided by trust principles to require them to act in the best interest of the beneficiaries. Now, of course, the trustee would welcome requests being made because that will make the distribution more meaningful, more effective. So the letter of wishes could say all this, and if it is a discretionary trust, the trustees would definitely give good ear to it, but they are not bound, legally bound, to follow it through if it is a discretionary trust. So, but nonetheless, if all things being equal, the trustees say, okay, there's a bonanza year this year in the trust, there's so much income, the client has said up to 40% for distribution, but such a bonanza year that 40% is a lot. Now up to, so what would the trustee, should I do 20, should I do 30, should I do 40? So the family council will be the one that eventually, under the family council, you will see we usually say that you should do executive committee. It's like you have a board of directors, maybe the board of directors may be 10 people. Then you have your MD, you know, one person or two executives who will this board of this executive committee really in a way will be the advisory committee. That is, they may be the same component, same people who are the executive are the advisory. I just use different names because it's a different, in a way, different role. This one is working with the family. Then they come here under the oversight structure. Now, the oversight structure is part and parcel of the asset protection structure. When we set up the documents for the trust or the foundation, they will be mentioned of the protector. They will be mentioned of the advisory committee. So, assuming the family council decide, well, this year is a good year, we don't want to distribute so much, let's just ask the trustee to consider 25% of the income, but put more into philanthropy, let's say. So the executive committee getting things done will be here to pass on the request. Now, if you don't have this kind of organized structure, let's think ahead. You have a family that's worth 400, 500 million. You know, we have families that are really there by the time they look at their structure. So let's say you have a family that amount and one generation. First, start off with 4 children. No structure, they just have kind of a protector, no advisory committee, the protector can have certain function over it. When the trustees want to act for the benefit of the beneficiaries, they may talk a little bit with the children to find out, but they talk with one, in the end they decide the trustee may decide on doing certain thing. They may please 3 others, because the others may feel, hey, and they may displease 3 others because they may feel, how come what we talk about is not taken into consideration and all that. But on the other hand, if you have an organized approach for the children to get together, talk about it, vote according to how the family constitution say, because we will have processes for dealing with matters. How it's like an M&A. You have the directors meeting, how it will be done, and then there, after everybody's in the council's voice have been heard, a certain decision is made to go, then people would feel they have been heard. And that's a very important response, we all know. When we feel that we have been quiet, we have been silenced in our position, we tend to feel, you know, that we have been sidelined. But if there is a very well processes, then we have a situation whereby the executive committee can carry the request to the asset protection structures to consider. And like, for example, and the family council does more. The family council does other family things, like, for example, deciding where to go for family retreat, right? And our charter would usually say you must give members 6 months ahead of the retreat dates and the retreat venue. Because the family members are all working full-time, they're studying, they have, if you last minute say it, it's difficult for them to organize their schedule to attend. So if you want to have a very good attendance, you want to let them know beforehand. So in the charter, it will talk about organizing a family retreat. And some clients, we must remember, the family governance structure is in a way dealing with a soft issue. It doesn't really have a legal personification. It's not like a Sundram Part. It's just a relationship between the family governed by this constitution. So therefore, if the children don't play according to what they want, strictly speaking, the family structure doesn't have teeth. It doesn't have teeth to bite the delinquent or the black sheep of the family. It doesn't really have. But some families will still want to, some family will still want to do it, like one of my founders would say, if they don't come back, if they don't attend the family retreat 3 times, then we will request, the family council will request the trustee not to distribute from the general fund distribution. So they try to put in some teeth, but all this is really, it doesn't have legal validity. It's not like a beneficiary can go and sue on this issue. But this is very important issue to be dealt with. If expectations are well managed, you will know that they will behave well as beneficiary. In fact, in North America now, we work with organizations who actually does beneficiary training. So basically, they train the beneficiary with their expectations of what to do in terms of the structure. So the focus of the training is to look at the structure not as your concentration target, but as a supporting companion of your life. Because if you don't train, beneficiaries may start to look at the asset protection structure as money source. But if you can, on the other hand, train them to say no, when it is founded, this structure is expected to walk alongside you to give you distribution, and to when times are tough, you still expect certain money to help you to tie over. Your children can have education, insurance policy may be taken care of. Some of the clients will actually have fund for that. So, but it is not something that you expect it to be your main source of income. You are expected to work to make your own livelihood. So therefore, but the family governance structure is that the council is the one that can decide on this kind of beneficiary training. Do we request a trustee for certain release of money to support that? We have a situation of family office. Now, this is not something that many families will do, but perhaps I wouldn't touch too much unless you all want to know more about it. Then I will speak with you. But if I start talking about family office, I probably will overextend my time. So then we have what you call the advisory committee and protector. Now, the protector role, of course, is important. If you look at some of the straight settlement trusts that are set up in Penang, you will find that there is some of them will have no entity, so-called, called the protector. In a lot of the trusts that we set up, or in the foundations that we have, the protector role mainly have two functions. The first function of the protector role is that it has the right to remove trustees. So sometimes trustee will say, all right, I mean, it's not a very happy occasion to say somebody can just remove me, but some will say, okay, you can remove me when I have committed a breach of the trust instrument. But a lot of times, trustees now have increasingly be open to the fact that the remover can be just as a matter of notice, paying up to date, and then there's a remover. Solely because sometimes there are many dynamics. The trustee is really such a key, is the key person in that structure. And there may be some reason, it may be that the trustee has been doing very well, but sometimes clients feel the person that kind of manages the relations has left. And, he would like to follow that person. Or maybe the fee for that year is so high that he decides somebody else has given. So this is a prerogative. So we talk about the fact, but the protector, after removing the trustee, can't become a trustee because it's a very strong power. Usually the protector will have to appoint another trustee to continue the trust. So the protector value here is just to be an overseer. So like in Labuan Trust Foundation Act, you have what to call the supervisory, is it the supervisory person? Yeah, the supervisory person, someone who is able to overlook the situation and say, hey, you might not be doing too well. You may not have breached the trust instrument, but I'm not entirely happy with the performance. The supervisory person may have that power to deal with it. So it's more how you structure the vehicle itself. The other role of the protector, usually we would put, is that before the trustee moves, the trustee on important issues, the trustee would give maybe 30 days notice to the protector to alert them that I'm like maybe a distribution of a certain amount. This will all be stated in the trustee. So it's not a loose arrangement. It's in the trustee. There will be a protector provision, the protector role, the protector power, and the protector liability, if need be. And there the trustee may be required to say, we will have a schedule. Maybe schedule may have 6 items, 8 items to say, on this, any decision touching on these issues, you would have to give the trustee a certain specified notice before you move. So now, it doesn't mean approval. There's a big difference. It doesn't mean that a trustee is seeking the approval of the protector. And we must remember that. Because if seeking of approval then it may mean that it's not a discretionary trust anymore. It is more alerting someone, the protector, who is usually either close, the family member, or maybe another independent person, but who has a closer tie and relationship with the family, who knows their needs and all that. It's a check and balance situation, so it's an information. Now the protector may come back and say, perhaps not this decision. Would you consider not this decision? Like, for example, in the letter of wishes, the client may say, I would want up to 30% of income to be distributed to my 4 children equally every year, but as a request. The trustee decides, okay, you know, there's a good income, we would distribute that. The protector give notice to the protector might be able to come and say, perhaps not this child. The child may be going through a drug addiction problem. You know that if you give him the money, it will go to the sources that are not right for his lifestyle. It may be some other reason. The trustee has the ultimate say. The trustee may still say, no, I do not take a decision from you. I will still want to distribute, irrespective of the fact that I feel it might not be the best interest. Now, of course, the trustee is running a big risk because it's the best interest of the children, right? But the fact remains is assuming the trustee would want to go against certain, which is not at all. I've never seen a case like that, really, because the trustee's main thing is to run with the best interest in mind. They're very careful with it. But just in case, clients always want to know just in case. Just in case, then you have a protector who will say, well, maybe I'll remove the trustee, I'll terminate the trust service, put on another trustee. So there's a kind of a check and balance there. But the protector does not override the trustee decision. We always say that clients sometimes set up a discretionary trust and then want to pump in a lot of reservation into it. I always say to the client that when you put in limitations and you want to retain controlling power, it is a knife that cuts both ways. Yeah, you think you may be cutting the trustee by removing this from them, but it also can cut you when something is being challenged. Because, like, for example, a trust, we know that a trust is not an entity. Unlike a foundation is an entity. A trust is a relationship. So strictly speaking, so you have trust principles of how a trust is set up. But strictly speaking, nobody knows whether a trust is valid or not until it's challenged in court. Unlike a foundation, unlike a company, you follow the specific steps, you get a certificate of registration, it is there. A trust relationship is a contractual relationship but taken on a highest level of fiduciary. But that relationship is governed by a trustee, which is not registered, which is a private document, and the trust relationship is defined and operate according to law. But until it's challenged, you really don't know. So assuming a client who set up a trust and takes the trustee like a rubber stamp, write email to it, and say, you know, I want you to do this, this, this. Of course, a dynamic trustee will turn around and say, we do not take instructions as such, but we will consider your request. But assuming the trustee didn't do that and just think that this is a good matter to invest in and just follow through the instruction, over the years accumulated behavior. And in the end, there is a challenge on the trust. A creditor challenges the trust, sues the founder. The founder says, I don't own it anymore, it's under the trust. But all this instruction for, if there's discovery, somehow documents surface, the court will say, you have not treated the trust with integrity. You have just treated the trust like your agent. It's like a stub. So they may call the trust a sham, right? So therefore, we have to be very careful in always holding the client's hand to remind them their objective and what they are. There's not. You can also set up a trust and have a fixed interest trust. All this is just that you must know what are the pitfalls and whether your benefits can be achieved. So, like, I have one client in Kota Kinabalu, and he, she was saying, now if I want to buy a diamond ring for 3 million, I just write a check. You mean I have to tell the client, tell the trustee now to give me the 3 million to buy the ring? So I say, first of all, you don't tell the trustee. You request the trustee for 3 million, right? Secondly, you don't put even your kitchen sink into your trust. Of course, you'll be having a lot more money outside. You know, what you put in is certain things that you want to ring fence. It's not like you're putting even your current account into the trust. You still have money to do your lifestyle, you know, so therefore you must, you know, a lot of clients say, oh, I'm putting everything, of course it's not right. But finally, even if you need to inform the trustee, if it is for the benefit, the trustee will react, because after all, the trustee is not taking your money for her own or for his own. The trustee is administering the trust for the benefit of the beneficiaries. So in a way, physically, I always say this, in a way, instead of eating like this, you might eat like that. You know, it's like a longer way, but it's a longer route that is a certain ring fencing protection. And if you respect the integrity of the trust, you will still end up having your good wishes being implemented, right? Because the trustee works that way. So therefore, we always say it has to be very, even for example, we talk about reserve power trust now, you know, like in Labuan Trust, Labuan, and in various trust jurisdictions, they have amended, they have had legislative development to allow it to be indefinite. They have allowed it to allow reserve power. So now what that really, in a way, means is that without the legislative amendment, a trust may be challenged because they are reserve power, and the court may say, actually, control is still with you. You haven't divested control. You may have changed the legal ownership, but you still hold the whip, so-called. So the Act says now, you have reserve powers in certain way, it is valid. Well, by the time the trust is challenged in court, the court will have to follow the legislation to say it is a valid trust, even though you have this reserve power. But the court may order the person who has the power to exercise the power to bring assets onshore. So like, for example, you have a situation, let's say there's a divorce, and there's a judgment, to say, okay, you have to pay settlement sum of 20 million or 40 million. Then the client will say, I don't have the kind of money, bulk of my money is in a trust offshore. It could, but the power, reserve power, you can exercise the power to have investment offshore, depending on what kind of power. But what we are saying is your reserve power may act against you. When the time comes, the court may turn around and say, all right, you have the power, right? Exercise it. Bring it onshore to answer the judgment sum. So we have to be careful to advise the clients in terms of drafting what they want and what they don't want. And I always tell the client, you cannot have your cake and eat it too. That's a given principle. You cannot want to have protection and claim the beautiful features that a common law trust gives you or a civil law foundation has afforded, and yet, on the other hand, wants to say, I'm still in control. You got to decide where your heart is and implement it that way and follow it through. So we have the, so maybe I could look at the next slide. Do we have time?
Millie,
yeah.
Is this the right time to ask my question?
Yeah.
Pros and cons between a corporate trustee and a board of trustees comprising individual trustees up to 4 people.
Oh, so corporate trustee meaning, let's say we will take TMF or Rockwell's a corporate trustee in there, and then on the other hand have, what is the other one? Several trustees. So again, there is no right or wrong, but we must remember, if you have individual trustees, chances are we are thinking about putting like family members, right? Is that what we're thinking of, right? Because if you have individual, you are getting each individual to come. If we are thinking of individual trustees to be, oh, my elder son together with so-and-so to be the trustees, you can have a lot of difficulty starting, number one, if they're not professional. I always tell the client, it is such an onerous duty to be a trustee. You are managing somebody else's property for the benefit, and your trust is the highest fiduciary relationship. Agent is a fiduciary. You know, we have directors have certain fiduciary duty, but trust is held on the highest level. So if you're not a professional and you ask your elder son to be like maybe your eldest son and the eldest daughter to be the trustees. And of course, in your trustee, you will have succession trustee, lah, who to come. You are asking the two trustees to look at the sea of beneficiaries who come with requests all over the place, many of them unjustified, but you still have to answer them. But they might not know how to put it in place, how to respond, how to deal with it. So, and if they do something which is not correct, you are looking at the beneficiaries who may sue you. Because, like for example, the clients may say, actually, you know, mine is very easy. I have just whole block of apartments that comes issue. So I give them, they just, you know, they're just doing rental income distribution. So why do I would need corporate trustee? Assuming they forgot to insure the properties. Property burn. They, as trustee, come out of their own pocket. But they have their own life to run to start off with. And you are just given added burden to them to deal with something because insurance of property is so important. There are so many dealing with brokers for letting, because the beneficiary will say, we have 10 apartments, how come it's all empty? Did you do your best to rent it? So all this, well, trustees might, professional corporate trustees will have the divisions to deal with it. They will ask, do you have your estate agent? Then we deal with the estate agent. You don't have the estate agent, we might have our own appointed. We have a right under the trustee to appoint other advisors to work on. So professional trustee would, when we say corporate, meaning a professional trustee, for a bigger estate is necessary. And I have always said, like for example, a lot of times, just when I was in Vancouver, a client asked me, Millie, I've been asked by a very good friend to be an executor and trustee of the will. It's a tough thing to do, because as a trustee, you are dealing with issues that need to manage to the highest fiduciary duty. So that's one. So, and then the other thing, of course, is if you have an individual trustees, succession always come about, right? When that gone, who to get, who, you know, so well, the corporate trustee has your profile open. You are a client, you are a trust they are looking at. So, and they have already got the letter of wishes and they work with the family. So it is it's dealing with, you know, it's even writing of a will, we say that, right? Writing of a will, you don't need solicitors to write a will. People, you can write your own will if you know the requirements of the will requirement. But if your estate become a little bit more complicated, then you might need to trust professionals who are trained in this field to write it for you. So, I know your family, you're thinking to put your eldest son to be there, you are literally setting him up as a target. He's already worried as a managing director of your vast estate. He now has this to answer to every beneficiary who comes along board to say, why didn't you do this? So, does that answer your question, Doctor?
Yes.
Does that answer your question? Yeah, you know, but no right or wrong, again, like I say.
I was thinking in situations where, you know, in Malaysia, there are a lot of high net worth individuals who are not business owners. Right?
Yes.
Maybe about around 5 million. And they want these assets to pass on to their generations. But if they were to appoint a corporate trustee or even go to a Labuan foundation, the cost of maintenance of such structures may be something which they are not willing to put up. So the only other alternative is under the common law trust, individual trustees. But like you say, it's a very onerous responsibility.
Yeah.
But at the end of the day, you know, you have to balance.
You have to balance. You have to, in a way, what we're speaking about is paying for professional services. You know, and if you have your son as a trustee, are you paying him for the professional troubles that he's having? Especially it's a big estate. The son manages it in one way. The sister will say, how come you did this? You know this is not a counter you should invest in. Why do you do this? There's all sorts of, you know, yeah.
There can be a situation where you appoint individual trustees first, and then you,
Yeah.
corporate trustee,
Yeah,
when
yeah.
they're going.
Yeah, usually when we do a trustee, then we have the trustee, and then already we will ask the succession trustee to actually be there already, and then have other provisions to say who appoints and what, right? So we have that. Yeah, definitely. I mean, in terms of legality-wise, person of sound mind, of a legal capacity, can take on trusteeship, right? As in private trust situation, common law trust. It's just in terms of practicality wise, and in terms of the burden that is being asked to put on that person, we have to think about that. You know, but you're right, you can start off that way. Let's say the eldest brother feel very comfortable, or the eldest daughter know this and is very willing to do it, set up the trust itself, and then properly done a trust deed, of course, all right? And then move on from there and say succession trustee is who. But that person that taking up the trusteeship should know what trusteeship is about.
I'm thinking of a situation where self-declared trust, either one or two, because the issue is the stamp duty to transfer from individual name to the trustee may be quite prohibitive.
Yeah.
So this is one way to get the structure started. And later on, when there is a death, when there's succession, the succession is where the corporate trustee comes in. When possibly at that time there will be insurance monies to pay for all the transfers and starting into a corporate trustee.
Yeah, so just recap that very quickly in case someone, didn't hear this. So basically, doctor is saying maybe have a self-declared trust. That means the person now who owns the 500 million of assets now declare himself a trustee for this assets in terms of beneficiaries that he's defined. So, and one of the reasons is because if you transfer the assets to the trustee, whether it is another son or another, then there can be a situation of stamp duties as one thing. So, first of all, we must remember stamp duty. I mean, I cannot speak off the cuff, but I do remember Stamp Duty Act in Malaysia might not just deal with legal ownership. If there is a change in beneficial ownership, which in this case there is, because last time legal and beneficial lies in the man. Now he says only legal remains with me, beneficial moves to the beneficiary. You might have to check whether does that mean that stamp duties is triggered, right? But even if it is triggered, I think the non-payment of stamp duty may not affect the validity of the trust. It merely means you have to do penalty and all that. Yeah, but that's something that you have to think of. Secondly, is perception. If you are the owner of this 500 million worth of assets, deal with it the way you want. Now declare yourself a role that you are merely the a trustee, is for the beneficiaries in that way. First of all, your creditors' perception is different. You're still totally in control. When you go to court, and the trust, remember the trust is not valid. You don't know the validity of trust until it's challenged. When it's challenged in court, your behavioral design will show how you treated the trust. You might even forget you make money, you wanted to distribute, you didn't distribute it from the trust. All these assets. You took the money out and then you use it to buy something else elsewhere, not accounting for it in the trust. So instead of the 20 million that was taken out to buy the farmland that's elsewhere, you bought it, you put it in somebody else's name, in your son's name, forgetting to trace that, right? So it's a very dangerous thing. So both from the outside point of view and both yourself, you act, on one hand, you are a trustee, on the other hand, you're a complete owner. So that will be the danger point. Legally can be done, but structurally and through integrity question, I always tell the client, you set up a structure, you got to respect the integrity of the trust structure for it to withstand challenges. What are we talking about? We're talking about asset protection. Asset protection means they are anticipated challenges that may come along. You want your structures to be robust. You want to be able to say, I behave as I set it up. So, but if you declare yourself, then that's the danger. So, doctor, did that answer your question, right? Yeah, okay. Just the pitfalls on certain structuring, right? So of course, we talk about when you set up this, I think I was also asked about jurisdiction. So, choice of structure and jurisdiction. In terms of options for choice of structure, there are many. We talk about common law trust. That is one of the, I think the more I study about common law trust, the more I see how flexible and a beautiful vehicle it can be. And I think it was Frederick Midland, I think, that says that common law trust is really one of the most distinctive achievements the common law has given to the general science of jurisprudence. And it is true. If you look at it, it is a very flexible vehicle. The concept of legal split ownership, that's how trust comes about, right? Trust comes about whenever a person has legal ownership but has to hold it for the benefit of beneficiaries. Arises a situation whereby, as a trustee, he has what you call a duty of loyalty for the beneficiaries. And so there is a question of split ownership, and that's why when the trustee is sued himself, not the founder, as the trustee is sued himself, these assets that are under his name are not available to his creditors because it's held in trust for the beneficiary. So it's a beautiful concept of split ownership, which allows shared ownership in the same assets. So, and the trust itself can be a discretionary trust, fixed interest trust, revocable trust, irrevocable trust, intervivals, testamentary, all different types of trust, but you structure it according to the objectives of the client's family, right? Of course, then you have the Civil Law Foundation. A lot of times in Malaysia, when we talk about foundation, we think of, the charitable foundation like Chang Min Tian Foundation, all the different foundations that arise. But actually, in a way, I was hoping that we wouldn't use the word foundation in Labuan because it can create a lot of misconception. But more and more, I find people kind of know now it's different, right? The foundation that we have, the charitable foundation that we have in West Malaysia, could be a company. Actually, it could be a company limited by guarantee. But it has charitable in its purposes, and then I think we have to apply to the Minister of Finance for the use of the word foundation. So, but that's different from the civil law concept of foundation. So, in a way, the civil law arises a different vehicle, and this vehicle actually is a corporate entity. So the foundation itself, unlike the trust, which is a relationship recognized by law, the foundation follows steps of registration, with culminating in the entity having a legal personality. So the trust itself is a relationship. The trustee has legal personality if it's a corporate trustee or if it's a person, has a personhood in it. But the relationship itself is not what you call an entity. However, on the other hand, a foundation itself is actually a legal entity. You can touch the certificate of incorporation and knows that if you follow the steps very closely according to the legislation, it has is recognized in law. It can be sued and be sued. It can host its own property, and the property belongs to the foundation. No split ownership. Legal and beneficial ownership lies with the foundation. Foundation can be set up for a purpose. It can be set up for beneficiaries, but the beneficiaries that are there have no beneficial interest because the foundation itself is a company that owns it. But the difference between the foundation and our company, most types of company, don't talk about company limited by guarantee, but most types of company is that a foundation has no shareholders on top. The foundation exists under the charter and regulating documents like some call it regulations, some call it articles, but basically the board of the foundations followed the mandate that's given in the written documents to administer it for the benefit of the beneficiaries or to perpetuate a purpose. The board doesn't take it for themselves, they are not shareholders, but they administer it. So in a way, that's why very commonly people will say it's almost like an incorporated trust. You have incorporation process, it's a corporate entity, but at the same time, it functions almost like a trust. Various jurisdiction, common law jurisdiction, and some quasi-common law jurisdiction have taken this proactive step of actually legislating this vehicle into their offering, so-called. So we have, I think, the first one I think maybe Bahamas. I think they might have done it in 2004. Then you followed by Jersey in the Channel Island. They did it, I think, in 2009. We have Labuan, who did it in 2010. We have Gervais, who did it in 2012. So various offshore financial centers and midshore finance, they realize that the needs are so wide now. Clients don't want to have just one offering. they want to come, especially like civil law countries, because this is a civil law concept. The clients who may want to decide, I'm going to set up something in Jersey or in Labuan, and they are not privy to common law. And if you tell them about the common law trust, it really scares the daylight out of them, because they're thinking, I have to transfer everything into a trustee that I have shook hands over the course of 1 or 2 years, but now everything to them. And if it's a discretionary trust, I only have a hope that they will do it according to my letter of wishes. It is very challenging for them to accept that. Whereas with the foundation, you see, like maybe I can briefly touch, like civil law countries, their law are codified. Their provisions are all codified. And the role of the court in a civil law country, they play a much lesser role than the role of our court in our common law country. So our common law itself is equally strong companion in our legal framework. Whereas the role of the court in civil law countries, generally speaking, they would come in to maybe resolve disputes. Their role may be enlarged because the constituent documents talk about these things, you go to court, then they might come in, but they don't have a general supervisory role in that sense, unless it's legislated in there, so or included in there, unlike our court in common law situation. Our common law, our court look upon the fiduciary duties of the trustee and a trust and consider itself as having a supervisory role. And people who can approach the court can be quite wide. If you have substantial interest, if you have a certain tangible interest in the issue, you can bring it to the court. So therefore, the trust, although you set it up, you don't have to mention many things, because we have the trust principles which are so well established, and the trustees, again, it comes to the fact, do the trustee know their work, right? If you have an individual trustee, they may not know all these trust principles in their mind, but corporate trustees, a dynamic, efficient corporate trustee will know this trust principle, and they will run with it. You don't have to specify in the trust deed. But on the other hand, for foundation, the focus of common law, civil law jurisdiction is you give the power as you wish it. So the focus is more on internal control mechanism rather than external control of the court coming alongside. So therefore, forming a foundation has different challenges, but it also has different benefits that come with certain clients who want that. Putting directors on the foundation board is also another very appealing characteristic I find to Malaysian and Asian clients. First, they quite like the fact that there is an incorporated body. They like that idea. I deal with it. I know it is a certificate number, incorporation number. I like that. Secondly is they have a say in terms of putting what they want in the articles, and then the foundation is run by board of directors. Or some of them call it council members. And different jurisdictions have different requirements. Like Labuan, the council, you don't even need a council, you need an officer to look into it, and then you must have a secretary that is registered trust company in Labuan, right? And then otherwise, you can have a council, you may not need to have a council, but the clients that I have always have a counsel, and you can put your family members there as a counsel to oversee the running, so they feel there is still a connectivity of their presence within you. Because if you get a trustee, you can't put your family members sitting on board of the trustee, the corporate trustee. But this one, you could do that. So some families like that, but again, like I say, it doesn't mean everyone should do it. Like one of my clients, multiple families. So, and when I talk about the foundation, at first it was quite appealing to have that. Then he realized, he said, look, Millie, no foundation, he says, already as it is, there's so much squabbles within the children who sits where in the family corporate structures. I have another foundation, there is another question of who sits in that foundation. I'm just creating an extra platform for differences. So he opted for a trust in the end. Something clean-cut, independently, no, they are just beneficiary. So we have to kind of look at what they want and deal with it. But it's definitely wonderful to know that Labuan has passed on the foundation, and clients should look carefully about it. And we must remember, when you remember we were saying that structures should have flexibility. In terms of Labuan Foundation, you can migrate. Foundation overseas can migrate over. So long as there is a flexibility, I always tell clients, don't only start when you think every knot has been untied. Well, substantially, you can see the way forward, do it, because only in real situation can you start to improve the system. If you want to improve the system on the drawing board, very difficult. All the time, you can improve it all the time. But once you have something, you see the practically how it works, then you want to do that. So, like, we can also have a structure involving private trust company, and like I say, sometimes we have combination of structure. You have Vistra Trust, so different trusts that can be used depending on need.
Can I interrupt while still you're on the foundation side? If you will compare your civil law concept of foundation with our Labuan type of foundation, what are the pros and cons? And just now you mentioned that you have to put the children into the foundation. I was thinking, in most cases, the children who are beneficiary of the foundation, technically or legally, they shouldn't qualify to be a director in the foundation because of conflict of interest.
Yeah.
Can you comment about that?
Yeah, sure. So in terms of different jurisdiction, let's look at, let's take concrete examples, okay? Let's look at Labuan, and let's look at Gervais. Then when we have concrete examples, we kind of, so like in Labuan side, because different legislations have different, have adopted different provisions. So in Labuan, like I say, you only need the secretary. The secretary of the Labuan Foundation must be a trust company. So the secretary, in a way, is more dealing with administrative functions. You have an officer that represents the Labuan Foundation, but that officer itself need not be a professional trustee in Labuan. It can be your eldest son, someone that you trust, or you can be your accountant, you can put anyone there, but there's no requirement that fixed on who you must employ. On the other hand, like for example, in Gervais, Gervais requires a council to have, in the council, which is like a board of directors, to have a person, what they define as a qualified person. That means right in the midst where decisions making are concerned, in the council board, you require someone to sit there. Same with Liechtenstein. In Liechtenstein, that we set up the OnStart Foundation that we do, the council requires to have a qualified person to sit on the council. Now, some clients may feel, oh, I'm happy with the Labuan Foundation because only the secretary who does the administrative work needs to be the Labuan trust company, but my council or my officer need not be that. And I want my children to start running until later on. I may then get more independent people to come in. So there's a flexibility. Again, in Gervais, apart from needing a qualified person in Gervais, as defined by the Financial Services Commission that they have, you also need to have a guardian. I think Gervais, you need to have a guardian. You have to appoint a guardian there. Whereas in Labuan, you need not have a supervisory committee. Sometimes families are small. You can't put so many people on different places. So in answer to your question is, which one is the better one? Depends on what the client's desire is. Sometimes also in terms of like Labuan, Labuan requires a charter to identify the beneficiaries. This is something that I'm just hoping to work with Labuan authority to look at. Some clients may feel, I don't want to be identified on the charter because the charter is registered in that sense. Whereas in Gervais, Guernsey, only the charter is registered, but you don't need that disclosure. The rest comes in the private documents of the articles. So therefore, when we sit with clients, we will distill from them what makes them feel comfortable, what are their needs. So, and we will talk about different jurisdictional features, right? So another very important about, like, if you talk about Labuan is some families, like now I'm speaking with families in Hong Kong, in Taiwan, they may start looking at Labuan solely because time factor. They want to be able to call up and be able to communicate. You put it in Gervais, they always have to see how many hours am I ahead, how many hours I'm behind. A little bit difficult. So of course now a lot of the Jersey service provider has representative office in Singapore or in Hong Kong. That's very good because it's closer to the Asian time factor. But still, Labuan has this added advantage of being in the time zone of where the owners are. So these are different. So the other question that you asked was whether you would want to put your family. So to answer you, you don't have to put your family there. Yeah, so the council itself can be made of, like in the first place, some jurisdiction in Labuan, you don't even need to have a council. You can have an officer who have the mandate following the charter, following the regulation, and the register secretary who will do all the filing and all that reporting, the tax paying. You don't even need a council. But if you do have a council, you don't need to put your family. You could put your trusted advisor. Like, remember we were beginning to say, would trusted advisor have a role? Yes. Sometimes my clients would put trusted advisor in their family council. Sometimes they will put it in there because they work with these people for 30 odd years. They want the children to continue to tap into the knowledge of these people. You can put your children, but you need not. But if you do, it doesn't mean that it will defeat, like the mind management control situation, because in a foundation, when you have this situation there, they are managing it according to the charter. The board member, the council member don't have an interest in the trust, in the asset. The assets still belong to the foundation. So the legislation allows you to do that. So what works best is not determined by the legislation in comparison. What works best is determined by your client's needs in comparison. They start off the process. We merely follow through by looking at what might be better serve their interests. Does that answer your question?
But the other thing is, just to clarify, if the children who are beneficiary, in the foundation, if they were to sit in the council as director, is it allowed in law, or will they be challenged or not?
Yeah.
Somebody sue the foundation thinking that
yeah.
You are in control.
Yeah. So that's a good question. Yeah, it is allowed in law because the legislation allowed it. The legislation the only thing the Labuan Foundation, I think, if you are a beneficiary, if you are a founder and a beneficiary, you cannot, like a beneficiary cannot sit on the foundation council unless you are a founder or a supervisory person. There's something like that kind of put a wall against it. But the founder usually can appear in many different places. But inside the act itself, it tells you who qualifies to be a counsellor, who qualifies to be a supervisory person. So, and those provisions have put in there probably because of the conflict situation that arises. So if you follow the provisions to the teeth, in that sense, then you would be able to set that up. But there are a lot of times that we set up foundation, the founder actually sits in the council because the law allows it. Therefore, in order to answer that question, different jurisdictions have different restriction on who sits in where. And most of this restriction, like I say, proceed with what you say because of conflict. Because of conflict, so the provision will say, if you are a beneficiary, you cannot sit here and there. So they have that. So you have to follow the different provisions in the Act. So we talk about choice of structure. So in determining the jurisdiction to establish the structure, there are various considerations. Clients will consider political, economic stability, robust legal system, proximity and accessibility, something very important to clients. So this is a common law trust structure. I don't think I need to, most of you would know that. You have a settlor law who then sets up a trust which then holds the holding company underneath it. In this case, we say it's a discretionary beneficiaries. It may include a settlor, and then you have a question of a protector there, advisory committee there. But you can see the black line is no longer there tying the settlor to this. You might also have a civil law. This is the different situation where you have a foundation. The foundation owns the offshore. I have put, like, for example, the trust, I have put it in a triangle, in a way denoting that it's not a solid entity. It's a relational and relationship vehicle, so-called. Whereas the foundation, I put it in rectangle, just basically saying it is its own entity of. Then the foundation can have a purpose. The purpose usually that I draft for clients is to advance the interests of family. You have beneficiaries in the discretion of founder, you have protector, you have advisory committee. Actually, I finished. So basically, this merely says that, no one plan with our clients' need being so complex, no one of us are able to take their needs and run with it. We all have to work and synchronize as a team to respond to their needs. And we will do design, we will work with the local solicitors, both the local solicitors in terms of where the assets are. Like in Malaysia, I work very closely with solicitors in Malaysia, because although I still maintain a practicing cert, but I don't advise opined on Malaysian law. So the Malaysian lawyers will work on this. Sometimes a client will come, just now somebody asked me who will we choose. So sometimes clients will come with their own solicitor. Some of them will say, I don't have any personal one. Most of them are corporate solicitor. Can you recommend? I usually will have a few firms that they can work with. And then and I will work with solicitors onshore in those jurisdictions where they set up the structure. So it may be Labuan, it may be Gervais, it may be Gervais. And at the end, we will have a reporting letter. The reporting letter will be a composite document that include various lawyers' opinion regarding their role and regarding the effectiveness of the structure from their perspective. So, yeah, and trusted advisors, of course, many a times can continue to play a role. If you are part of the planning, you can be privy to be part of the role. Okay, so thank you. Thank you, yeah.